Good afternoon. Here are the closing market comments for Wednesday, October 27th. Well, the grain markets opened up this morning with some moderate losses, but all of the grains climbed back to close better on the day. No large gains today, but the move quite impressive nonetheless, especially when considering that all of the outside markets were quite negative. December corn finished 5.5 cents higher at 5.76.5. July corn up 4 3/4 at 5.98 3/4. November soybeans up 2 3/4 at 12.21 3/4. July soybeans up a penny at 12.44.5. Kansas City winter wheat up 13 cents at 7.51.5, and Minneapolis spring wheat up 9.5 cents, finishing at 7.55 1/4. Outside markets were mostly negative today, but grains rallied despite the negative outside markets. Crude oil currently 62 cents a barrel lower at 81.93. Gold market about $16 per ounce lower at 1,322. U.S. dollar index up 51 points at 78.42. And the stock market 112 points lower, with the Dow currently trading at 11,057. Live cattle closed 10 cents lower at $100 even, while the December hogs were 82 cents lower at 67.85. In outside market news, lower crude oil, gold, along with a higher dollar put pressure on our grains early in today's trade. We also have a Federal Reserve Board meetings that begin next week on Tuesday, and the potential amount of dollars that the FOMC could pump into the U.S. economy to spur economic growth is being widely discussed. General thoughts are that additional quantitative easing is likely to keep the overall trend in the U.S. dollar heading lower, which would be supportive to commodities. In grain news today, last week we heard a lot of talk about China had either bought or was interested in buying up to 1 million metric tons of U.S. corn. Now there's talk in the marketplace that China's sniffing around in the world market for wheat. And again, anytime China's in the market sniffing around, typically tends to push prices higher. There's no major world weather issues right now, but there's a number of areas that have minor issues and bear a little bit of watching. The U.S. Central Plains are very dry. They've missed out on some of the recent rains, and that's primarily affecting the winter wheat crop. The Russian winter wheat crop is off to a less than ideal start. And the Australian wheat areas, which are too dry in the west and too wet in the east, having the general thoughts that Australian production is easing off just slightly. South American weather looks mostly favorable for the next week to 10 days. We do have a strong La Nina that's in place in the Pacific Ocean right now, and that'll need to be monitored quite closely, especially over the next 90 days, which will be the heart of the South American growing system through November, December, and January. La Nina conditions have a tendency to create warmer than normal and drier than normal conditions in southern Brazil and Argentina. Today's price action in the grains was quite impressive given the negative price action in most of the outside markets. The grain trade's independent strength today is likely reflecting the market's attitude that U.S. and world grain stocks are tight, and at this time there's no sign that prices are high enough to create significant world demand rationing. As we wrap up the U.S. harvest for corn and beans, some areas may be a little bit disappointed that yields were not as good as it had been hoped for, but overall pretty good crops for both corn and beans in the United States. Sometimes it's tough to get bullish or to understand why the marketplace is so bullish when we've got pretty good crops coming off of the combine, but I want to look at a couple of graphs today that show just why it is that there's a lot of bullish attitudes towards these grain markets right now. Let's take a look at world coarse grains, and of course that includes corn, sorghum, oats, and barley. And let's look at the ending stocks, which is the orange bars on the graph, and then the stocks-to-use ratio, which is the blue line. We have a very significant reduction in world stocks of coarse grains this year. Last year's ending stocks near 200 million metric tons. This year coming in just a little bit above 160 million metric tons. So we have a significant reduction in the world coarse grain ending stocks. But possibly even more significant than the overall ending stocks levels is the stocks-to-use ratio. Again, in the blue line. Our stocks-to-use ratio is going to be very near the lowest level seen over the last 30 years, similar to what we saw back in 2006. We had a very, very tight coarse grain situation worldwide. Now, this isn't new news, but the fact that we still don't know if we've seen the lowest stocks numbers. There's still thoughts that the U.S. corn crop could be getting smaller, and there's still thoughts that overall world demand is still increasing. And if that's the case, it could pull this stocks-to-use ratio even lower into near-record territories. And, of course, that's one of the major reasons why the marketplace is still friendly to corn and grains in general. Now we'll take just a little different perspective on the world corn situation, and this graph is the days of supply. And as we can see, in corn, we're now below 60 days supply, at least the projected ending stocks for the world corn situation, and that's near the lowest days of usage we've seen in corn, only a couple other times below 60 days, and by far some of the lowest numbers we've seen in the last 30 years. Taking a look at our December corn chart, corn prices still consolidating here ahead of next week's Federal Reserve Board meetings and also the November 9th USDA crop report. But today's close was quite impressive, about the highest close we've seen in nearly 2 weeks. The overall uptrend is still in place, even though we're consolidating for the moment. Turning to the November soybean chart, earlier this morning it looked as though we could have a reversal day in the soybeans as we traded quite a bit lower early in the session. But today's close, very impressive, actually higher on the day and a new high close for the move. The long-term uptrend in soybeans is in place, and it does not appear, at least at this time, that there's any topping action. Since soybeans are making new contract highs, new highs for the move, let's take a look at a weekly chart here for just a moment and take a look at where the next levels of overhead resistance may come in. Again, as this market is making new highs for this move, the marketplace probably focused now on 1291. Those were the highs that were posted back in the spring of 2009. And so another 60 to 70 cents still looks likely, at least from a chart perspective, and that would be the next level of overhead resistance. Taking a look at our Kansas City December wheat chart, this chart is starting to look a little bit more friendly. Our lows over the last week or so did not challenge the lows that were posted back in early October, and right now it looks as though this market is heading for those previous highs in that 776 to 782 level. That's only 20 to 25 cents from where we're at right now, and with the corn market rallying and wheat now gaining a little bit of momentum on its own, it does look as though the highs from both September and October could be challenged here over the next week or so. That'll wrap up this afternoon's broadcast. Thanks for joining us, and have a good afternoon.